Are you moving to Nashville and getting a VA loan? Do not sign that paperwork until you've watched this video. My friend Meredith at ServisFirst Bank has created a program just for you that avoids paying the funding fee, the 1.65% funding fee on your first home, all the way up to 3.6 on your second one. That's a lot of money, and she can show you how to not pay it. This is not a scam, it's not a trick, nothing on the back end. I just want to give you this information so you save money. See you on the inside. All right, what's up, everybody? I have Meredith on the call with us today from Service Bank, and obviously Chris, who works with me. We partner up at EXP, and Meredith has some awesome packages for on the lending side, and so I want to go into those today. Specifically, two of them that I like, and you can go obviously tell us more about what you have, but the VA loans and the renovation loans. Two that are just, that people don't always hear about. So, but before we do that, Meredith, tell us about yourself. Tell Chris that she just met Meredith.
Yeah. So I started in ServisFirst in 2007, and then worked on the commercial banking side. I was at Regions Bank before ServisFirst, and then continued in private and commercial, starting in 2007 at ServisFirst, and then moved to mortgages about a year and a half ago. So I've been on the private and commercial side for a long time, and I just kind of made the switch over to the dark side with you guys. For mortgages.
Yeah, welcome.
Mm-hmm. So I did a lot of construction lending, both on the private and commercial. Like I did a lot of commercial construction, that kind of thing. And all of my private banking was, kind of the principles of those commercial businesses, that kind of thing. So I did, if they were building a beach house or if they were building a primary house, we did construction lending back then. And so mortgages were not new to me in any way, but it's definitely a little bit of a different ball game here in the residential mortgage world. Only I tell people our hair's on fire every day, but it's
always right. Always something.
But it's been fun. It's been fun.
Yeah, that's cool.
I like to tell people that our bank was founded with kind of a white glove approach to banking. So with that, when it comes to mortgages, we can do anything that a broker can do. I mean, we can package up and sell a product, anything that they can do. But because a lot of our customers didn't fit in that box, mortgage companies love to draw boxes. And if you don't fit in the box, you don't get a loan. Because they like to do that, and our customers don't really fit in a box, we came up with something called portfolio products. And they're just proprietary products to us. And I'm sure there's other banks that have them, but we're not a broker. So we can come up with our own products and just hold them there on a portfolio of the bank. The best way to describe it, the first one we came up with is the best way to kind of introduce how the portfolio stuff works. UAB, we're headquartered in Birmingham, and UAB is there. UAB spits out, I don't even know how many hundreds or thousands of doctors, dentists, you name it, every year. And then, of course, we've got all the law schools around, all that kind of stuff. So we said, okay, these guys, they get done with, however many years of school, residency, fellowship, all that. And now all of a sudden they're a doctor. They have a huge salary. They have huge student loans, and they have not a single dime for down payment. But we knew as a bank, if we come up with a product for these guys, then we'll have a customer for life. One day they'll open their own practice, and we'll do the loan on the commercial side for their practice opening up, or the real estate, or anything that goes along with it. So we said, okay, if we take care of this one need that they have, or they can't buy a house, even though they have plenty of income, then we'll have a customer for life. So we came up with our first portfolio product. And Scott has some little flyers that I emailed out. The one that says professional mortgage on the top, that's the one I'm talking about right now. It's doctors, dentists, lawyers, engineers, pharmacists, CRNPs, CRNAs, anybody kind of higher education. We call them professionals. And this product fits for them. And we came up with this. It went great. And so then we made more. This particular one, the professional mortgage, it doesn't count their student loans against them, which is a big deal, especially for these doctors that are finishing up. And it's exactly like the VA one I'm going to tell you about, in that it's 100% financing because they don't have a down payment yet. And there's no mortgage insurance. So wow. Really, really cool product. That gets the doctors in a house right out of their fellowship while they're going to become go to work, join a practice, join a hospital, whatever they're doing. And so that product went really well. And that's why we said, okay, well, let's do more, and came up with more.
Is there a max on that, on the purchase price? or
Um,
does that depend on the area?
so we have a soft max of 750 on it.
Okay.
The flyer says 750, but there are so many times we have to go over that. That was kind of when we first came up with it. That's what we put in there. So it's not hard for me to make an exception on that. And they're actually looking at increasing it officially just because that number doesn't really seem to work.
Gotcha. A portfolio loan. Explain the difference between a portfolio loan and just one that gets sold to a bigger bank.
So when I sell loans, it's kind of like the brokers that I'm sure you deal with. We go out, we get somebody in, we say, okay, this is conventional. Here's the down payment. Here's the DTI, the credit score. The difference in a broker and us is we are a bank when we can't underwrite our own loans, and we're actually delegated by Fannie and all the investors to underwrite for them. So it's not like we're packaging it up and sending it out to 5 or 6 different banks and going, okay, who wants this one? And then they all pull their credit and all that. It's not like that. We actually grab it. We take a look at the profile. We see what the best investor is for that person. We underwrite it, and at the closing table, we sell it to them. They know who it's getting sold to while they're sitting there signing papers. And it's actually that investor's papers. So it's a little bit different than a broker, but real similar to what you've dealt with a broker, other than the fact that we underwrite it internally. Those
Gotcha.
are what we call sellable loans. They are the things that fit in the box, that there's no exceptions. They, all the normal stuff that you probably deal with every single day.
Okay.
Those are called sellable products.
Okay. And then the portfolio is the portfolio loan different, or is that
It's a
what
little
you
bit
were saying that
different.
was? Okay.
We have guidelines that we follow for each one, but the bank is just going to keep them on our books. We're not going to package it up and sell it to anybody. We have a servicing arm that helps us like send out bills and that kind of thing, but we hold it on the bank's books. They could walk into ServisFirst Bank in Nashville and pay their payment right there. I mean, it's a bank loan.
Okay. So because you're keeping it in house, you can come up with whatever things you want, and that's why you're able to come up with your own product for a doctor or these people or the VA, which we'll get into, right? So you can create your own standards and whatever you need to do, and that's why you're able to say, okay, we're not going to count student loans because we're keeping it in house. We can. I don't want to say do whatever you want. I'm sure there's some regulations regardless, but you can create your own products, which is
Right.
which is a bit. It's a big deal.
Yeah, it is. It's been the thing that's really set us apart from our competitors for sure.
Yeah. Okay. So portfolio loan is going to be in-house. So when we talk about portfolio loans, that pretty much what that means is the bank is keeping it in-house. So you don't have to have the rigid guidelines that you would need if you're going to sell it to another bank.
Right.
Okay. Okay. So let's get into the VA loan. Because this is one that you told me that people don't believe you when you tell them about it.
So 99% of the time, somebody's gotten pre-approved with one of the typical VA banks, right? And then, they had one guy that made 43 offers using a VA pre-qual letter and didn't get a house. And this was like what, 8 months ago. This was in the thick of it,
Right.
And he had his pre-qual letter, but I mean, that price point was just a super popular price point. And y'all have had them where they just say, no, I'm only inside in conventional. 43 times that happened to him. So somehow his agent heard about our product, and she said, call this girl and ask her what she's got going on, because my pre-qual letter is a conventional pre-qual letter, but you only get this loan if you qualify for a VA loan. So it honors the spirit of a VA loan. It'd be a slap in the face to the service members if we gave this loan to anybody that didn't qualify for a VA loan. We're going to make sure we even run it through an automated system to see if the VA would approve it. I mean, everything is if we're giving a VA loan, but instead we're giving you a conventional because it's portfolio. So he all of a sudden had his pre-qual letter that said conventional on it, and 44th house he got it. So it was the difference maker for him. And that's I've got that story a million times, but that's the biggest one with 44.
That's an amazing story. And I mean, Chris and I have dealt with this. Like we write offers, right? Even sometimes even with a conventional loan, it's like we're losing to cash and all these things. But especially with a VA or FHA loan, it's like we don't stand a chance. And I don't know why that is. I think part of it is because you don't have to put as much down, and so the seller looks at it as a risk. Oh, well, maybe they don't have any money to put down. on the other side, it's like, well, it's a VA, like they're taking advantage of something that they should, right? Like, why
They
why
earned
wouldn't
it.
you take
Yeah.
advantage of it? Yeah, why wouldn't you take advantage of it? But the seller gets to decide at the end of the day, and
Mhm.
so it's a big problem. It's obviously the market's changing right now a little bit, but it's still when for whatever reason when someone sees the FHA VA, they think risk, and
Mhm.
a seller can, and so this eliminates the risk on having to show that it's a VA loan.
Mhm.
Okay, so I just want to make sure that I'm understanding right. Okay, so it's not a VA loan,
No.
but I mean, it doesn't. You don't have to. Okay, so with a traditional VA loan, what happens to it? Let's say if you were going to do a VA loan, you would have to use their paperwork, and then you pretty much sell it to them, right? Or
They
explain how that would work
guarantee
if
it.
it
They
was.
guarantee it.
Okay, they
So,
guarantee it.
mhm. So one part of that is we check what's called their entitlement. We pull their certificate of eligibility and make sure that they have eligibility to get a VA loan. That's like item number one for a VA loan. Um, if someone has had a VA loan before, they still have it. Maybe they still own the house. Maybe they sold the house and nobody ever cleared it up for them. On their certificate of eligibility, it'll list that they already have used their entitlement, is what it's called. And so a lot of times I'll help them clean that up because it's like a house they sold. I say, send me the settlement statement. I'll get that cleared up for you. Because we do want to see a clear COE ready for us to put a VA loan on there, even though we're not actually putting a VA loan on there. We don't want to give it to anybody that wouldn't otherwise get a VA loan.
Right. But let's pretend it was a real VA loan, like that it had to go through that. What's that process, and what is the cost to a veteran
Okay.
in a normal situation?
In a normal situation, we're going to check, and it's very similar to, I'll go over the normal situation. I'll go over this one. Very similar to the process that we go through. So the first thing we do is we pull in rates from all of our investors, and we have 8 or 9 different investors. We're constantly adding them. Right now, I think we have 9. So we pull in all the rates for a VA loan for that credit score, that debt to income ratio, that LTV, although most of them you do 100%. That credit profile, everything. We say, okay, which one of these investors has the best rate for this loan today? And we pull in the best rate. So you get the VA rates, which are better than the rest of us get for conventional. And we also kind of shop it around because we check 9 different investors and see who has the best rate. At that point, we've pulled it in. And if we're doing a regular VA loan, then we might sell it to a SunTrust or a Wells Fargo or you name it. And we follow along their guidelines for their VA loans. So when you're doing a real VA loan, you're following the VA guidelines, and you're also following whoever you're selling it to's guidelines and making sure that you're packaging it up to where they'll buy it the day of closing with no problems, and that it also qualifies for the VA. Whenever I'm doing my ServisFirst VA, I do the same thing. I pull in the rates, make sure I give them the best rate so they still get to shop around and they still get the VA rate. But at the end of the day, I don't actually package it up and sell it to that bank. I just keep it at my bank. Whenever on the real VA, whenever it gets packaged up, the VA is going to charge a first time use, not first time home buyer, but first time use of your VA benefit, a 1.65% fee. They call it a VA funding fee. You can add it to your loan amount. So, in the circumstance of a $300,000 house, they might borrow, I need to do the math, but whatever, 1.65% of 300, their loan amount day one is more than the purchase price of the house. If it's the second time they use their VA benefit, then they're going to charge them up to 3.6%. It's between 2.3 and 3.6, and it depends on if you put a down payment. None of them ever put a down payment. Rarely do they put a down payment. So it's usually 3.6%, which is a huge number. So they're going to start out somewhere in the $310,000 range of their loan amount day one for this $300,000 house.
Yeah. So it's almost 5,000 for the 1.6%.
Mm-hmm.
And so then, so on a $300,000 house, it's almost $5,000 a funding fee.
So they're upside down day one, which I'm not bad mouthing the VA program. It's a great program. There's a purpose of it, but there's a cost involved in it.
Well, but the reason that I wanted to bring it up with you is because that's going through the process, you probably don't think about it because you get to put it on the end of your loan. It's easier to do it that way. But knowing that there's a product out there that does the exact same thing minus that fee, and then does that count? So let's say if they sell this house, that they went through you, that's a portfolio loan, not that didn't go to the VA. There's, if they want to go buy a VA, let's say if they're in a state or area that you don't service, would they be doing the first funding fee, or would they have to go to the second one?
Yep. So I had a first time home buyer, had never used a VA benefit before. They got my ServisFirst VA loan for their very first house ever. Let's say we don't have this product anymore, or like you said, they go to somewhere where we don't have a market and we can't do this VA loan for them when they move. They're going to be first time use because they've never used it.
So it doesn't count again. So it's technically not it's not the VA loan. I mean, you call it a VA loan because you have to be a VA and you have to qualify for the same loan. That's a big deal. And I mean, I've never heard of anyone who does that before. So that's pretty cool. Well,
we got the professional and we said, okay, well, that worked. Well, then we started seeing our service members weren't getting loans and they weren't getting houses. So we said, okay, well, let's come up with one for them. And the other good thing about, the other drawback, I guess, let's say in military moves every 2 years, 3 years. Let's say they get that $300,000 house, they owe $310 on it, and then they have to PCS and move in 2 years. In the market we're in, that's not a bad thing, but in some markets, they could be upside down.
Yeah.
So they don't have that fee. I wanted to make that point too. But yeah, so they'll be first time use if they have never used it before. And there is absolutely no drawback. So there's no mortgage insurance. You get the VA rates. There's no funding fee. Every benefit of the VA loan is included. And then kind of the drawbacks are not included.
Yeah. So there's no catch. I mean, that's what when we talked about this before, people were like, well, what's the catch? What's the hidden fee or something? And there's not one. I mean, that's because you were able to get together and say, hey, let's create a product that's better than anything else out there. And because you're keeping it in house, that's why you can do that. It's awesome.
Yep. So in the guys that are like, trying to get a loan through a traditional bank, they'll call that bank back and say, hey, I'm going with a different bank. They have this product, and they'll describe it to them and they'll say, she can't do that. She's going to charge you a funding fee at the end. And no, I'm not, but they don't have this product. They only offer what they can sell, and you can't sell this. It doesn't fit in the box. So they don't understand it. And I say, yeah, I hear that a lot, but I promise I've done a lot.
But I can do it. It's
I'm not going to charge you a fee. So.
Yeah, that's awesome. Okay, cool. So we got the doctor or professional portfolio loan. We got the VA loan. What's and you may have more, so feel free to share whatever you want to share. But the other one that I thought was cool was the renovation loan. So explain that one.
Okay, and let me tell, just while it's on my mind, when we do portfolio loans, we are only supposed to do those in our assessment areas. So Davidson County is our assessment area. I want to talk about that. That's why for the professional, for the VA, all these, they really need to be in our assessment areas. Now, the construction perm doesn't have to be in our assessment area unless we do a portfolio for the long term, which I'll get into that when I explain the product. But I did want to mention that has to be in the county where we have a bank to do these.
Okay, so yeah, so people in Clarksville can't, unfortunately, if they're living in Clarksville, can't take advantage of this. But I've done some VA loans in Davidson County where they just want to, they drive to Clarksville. So and you said, and that might change down the road, or if they're moving from the area and they go to a place where your bank has a location, then they can potentially take advantage of it in that county, depending on where they go.
Right. And we're all over. We're I guess the farthest north is probably Nashville, and you go straight down I-65. We're in all through Alabama, all the way down to Mobile. Then all over Florida, Tampa, Orlando, Pensacola, obviously Atlanta, Charleston, Charlotte. We're kind of all over the Southeast. So if you have somebody leaving Clarksville and going to Charlotte or Charleston or Atlanta, somewhere like that, then we could do that product for them.
Okay, cool.
But if they're buying in Clarksville, then obviously we can make them a VA loan, and we're good at that as well. So
yeah, and you can do the traditional one as well. Yeah.
Right. Okay. So other portfolio, and I don't have a flyer about these other ones, but like, I had a guy who was a commercial customer of the bank, certainly valuable to the bank, and he wanted to buy a house on 80 acres. Well, guess what? That didn't fit in the box. So we have loans for those. We have a standard portfolio and we have a jumbo portfolio for the things that don't fit in the box like that. Like I've used that for the guy with 80 acres. I've used it for loans that are like 2.5 million, 3 million, up to whatever, because you can't get a traditional mortgage for more than, I think, 2 million is the limit right now. So we have portfolio loans just for those outside of the box scenarios for people that are clients of the bank or prospective clients of the bank. I just don't have a flyer about those because it's kind of a different thing. But the other cool one is our construction perm, and I sent Scott the flyer on that one too. And I've done 2 of these in Nashville that were renovation perms. So whenever I describe this program, I always start with when I built my house. So I have a house that this is before we had this product. So this is the old way of doing a construction perm loan, right? It was 2 different pieces. I got a loan and bought my land. And then I sat for a year and kind of thought about it, figuring out what I wanted to build, redrew the plans, all that kind of stuff. Then I went back to the attorney's office again, closed again for my construction loan, for my 12-month drawdown construction loan period. And then when I was ready to go to my permanent loan, whether it's 15 years or 30 years, whichever one people want, when I was ready to go to my permanent loan, I had to go back to the attorney again, close again. Of course, you have the rate risk during that 12 months of construction. And so I closed 3 times before I moved into this house. And then I refinanced for 15 years. I actually closed 4 times. So this is 2017. If we had had this product at that time, I could have combined all that into one. We only do it for primary and secondary residence. That's a key point to make. But let's say that I had my plans and specs and budget and everything ready. And I'm like, I know what house I'm going to buy. I just have to find the land. And then I find the land and I'm going to go buy it. So I would send the appraiser out in that circumstance of, here, they're buying this land. They're going to build this house. What will it be worth at the very end? And he gives us an appraisal of, like you do for a construction loan at the very end. Now, some people just want to buy the land and then worry about it. So you might end up having 2 closings, but you don't have the 3, depending on that land piece.
Okay.
So y'all probably won't run into too many people that already have the land that are trying to do construction. So that's why I kind of wanted to make the point of it's a little bit difficult to make sure you have your plans and specs and budget and all that before you buy the land. But if they do, then this product could help them combine all that into one. If you're just helping somebody buy land and they're going to sit for a year like I did and decide what to do, I can help them combine the construction loan and the permanent loan into one closing. So the way it works is we say, all right, at the end of the day, this house will be worth X dollar amount, and we can loan up to 80% of that number. So the first draw might be the land purchase. The first draw might be paying off a land loan that already exists. Then they get started on construction. We send the inspector out. He says they're 10% of the way done. We free up 10% of the money, just like a typical construction loan. And we have a 12-month, 18-month, or 24-month option for construction, depending on what you're building. At the end of construction, there's no refinance. You don't go back to the attorney and close again. All we do is we check rates at that time. If rates have gone down, you float down. If rates have gone up, you're already fixed with what we closed day one. So it's high side protection on the interest rate. It can only go down, it can't go up. And you sign a modification because you're moving from an interest only drawdown loan type to a 30-year principal and interest loan. So you do have to sign a modification. Hey, I understand what my new payment is. If the rate went down, I understand what my new rate is, but it's not going to the attorney. There's 0 closing costs at that point. It's just modification to the payment. A couple of documents
awesome.
For 30 years.
How much money do you think that would save somebody going from, 3 closings to 1, just in the closing cost side of it?
Gosh. I mean, your attorney, your title, your recording, all of it, appraisals, all of it.
Yeah.
And a lot of these are typically larger size loans, so the fees are a little bit larger.
Or higher, yeah.
And the 2 I did in Nashville were for renovations. So they had a house that they purchased that they wanted to do a major renovation on. One guy is basically gutting and redoing the house, and one guy is doubling his square footage. Either way, we said, all right, give me the plans. All right, when you get done, it's going to be worth this. We paid off the original mortgage, and then they're still in construction right now.
So that was one that they already owned. Mm-hmm. You came back in. Interesting, because I've done a renovation loan where they didn't own it yet, mm-hmm. and they had to come in. But I've never even thought about having someone do a renovation loan with a home they already own.
The key a lot of times is making sure that the adding square footage is key, because I mean, y'all know how appraisals work. There's not too much of a difference of a old house versus a new house if you're not adding any square footage or bedrooms, bathrooms, something like that. So ideally they either owe very little or they are adding square footage. So they're getting some value. Otherwise it makes the numbers hard to work. But yeah, it works for renovations.
Yeah, the numbers have to work. So on that one, let's say you already own the property. And then let's say, so you just, as long as it appraises for what, 80%, does there have to be like a 20% buffer in there somewhere, or could it be less than 20% if it's their personal?
Let's make up some numbers. So let's say somebody owns a property right now and they owe, I don't know, 200,000 on it. And the current value's 300. But they're doing, like our guy that's doubling his square footage. They're doing a large renovation project, adding square footage, something like that. And maybe it's a, I don't know, $300,000, $400,000, $500,000 project. The appraiser comes out, and let's just talk round numbers. So what if the appraiser comes out and says, when they get done with this, it's going to be worth $1 million. Well, at that point, my loan amount can be up to $800,000. So when we sit down and we close the loan, they sign $800,000 loan documents. The first draw comes out to pay off that $200,000 mortgage, and then they have $600,000 to play with that we'll do draws for over time. It depends on what they're doing. I mean, the construction budget could be any number. So it has to be, cost or appraised value, whichever is less. So I guess, that comes into play. So if the appraiser says it's going to be worth $1 million, I can loan 800.
Okay. Yeah. That's awesome. And do you pay the general contractor directly? Like it has to be a general contractor doing the work? Is that?
It does have to be a general contractor doing the work, and we have to approve the general contractor, which is not hard to do. If the general contractor banks with us and they have a good reputation with us, they're automatically approved. If not, we call references. We check a few things, make sure we approve them. That's not anything the customer has to deal with. But we don't pay them directly. I always open an account in the borrower's name because I don't know if they've gotten sideways with their builder or anything like that. So the inspector says that the money's freed up. I drop it in the borrower's bank account, make the draw on the loan, put it in their bank account, and then the borrower has the last say-so to actually pay the general contractor. A lot of times the general contractors actually bank with us. And so the borrower will say, hey, just transfer this from my account to theirs. And we're happy to do that.
Gotcha.
But they have the last say-so in paying that general contractor the draws. I'm not going to pay a general contractor for them.
Yeah. Gotcha. But the work has to be done by an approved GC, general contractor. Okay. Yep. Is that a pretty large list, or is it?
It's growing every day. We're adding them every single day. I mean, it's not terribly difficult to get approved. We just check a few things. We usually check with their bank and make sure they have a good history with their bank, and they don't commingle funds with other projects, things that protect our collateral and protect our borrower.
Yeah. That's awesome. I mean, I think these are things that people don't, always know about products like this. And so especially if you're creating them on the inside, just getting the word out about them and the potential to save people a lot of money. So it's awesome. Chris, you got any questions?
No, this is very cool. All these packages are really awesome. So how many people are actually doing this? Or do you know of anyone else that does stuff like this?
So a one-time close construction perm, I think I've heard of one other bank that does them. Mm-hmm. Typically, you have to be kind of careful with them because you can't change anything after they're done. Because, once you sign for your construction loan, you're done for 30 years. So they're pretty rigid. So the good thing about us is you can't change the loan amount, but we can work with you on things. Like some banks say, all right, we can only have 4 draws within your construction period. I have people that email me every single week for a draw. And as long as the inspectors approve it, I'm good with it. I don't restrict you on all those things. So I think ours is a little bit better just because we aren't as strict as other banks are on those kind of things. But I have heard of one other bank doing a one-time close. And the good thing on that is that rate protection. I mean, you have no risk in the rate. It can only get better. It can't get worse,
And the VA one, yeah, it's really cool.
Yeah.
I've heard
of doing that one yet. They'll pick up on it at some point.
Right.
Yeah. Well, that's one because I've heard of doctor loans before. I wasn't sure exactly how they worked as far as are they portfolio loans or what, but the VA one I've never heard of. So I've never heard of anyone doing that one. And then so yeah, it's definitely good for us to know and have in our back pocket for when these things come. And again, obviously Meredith does just the normal traditional ones as well. But everybody knows about those. Those aren't as fun to talk about. Appreciate the time and
thanks, guys.
Yeah, more
glad
people
that you're doing it.
Myself need to know about this.
Say it again, Chris.
I said more people than just myself need to know about this. So
for sure.
Yeah, seriously. Yeah. Well, yeah, because she just told me about it last week, and I was like, oh man, we got to make sure people know about this product. So,
well, and we're always looking for regular VA also. I mean, obviously, we started doing this VA in November, and I don't think we've done a single real VA since then because there's no reason to. I mean, not in our markets. So, and to keep up our licensing for VA, we do have to keep doing VA loans. So, if you have people in Clarksville that are buying in Clarksville, I'd love to help them with the real VA loan. I'll obviously take good care of them. Scott can vouch for me on taking good care of folks. But if they're in Davidson County, we can do this ServisFirst VA for them for sure.
Yeah. I love it. Appreciate it.
Thanks,
Meredith. Well, yeah. Talk to you soon.
All right. See ya.
Thank you.
See you, Chris.